So Leo gets liquidated, the forced selling ends, and we've got Kenny G to the rescue, restoring confidence in the high beta AI trade. It sounds bullish until you realize that the 10-year rate is breaking out, as is the 30-year. Just as quickly as Citadel bought those assets at a discount, they likely turned around and sold some, if not all of it, up 15 to 30% the very next day. That would lock in an insane risk-adjusted return, which is the whole premise of block trading. So is it high beta confidence, or is it just a quick buck? Hyperscalers are holding up well enough here to anchor the market and maybe even push it slightly higher. But volatility and the leadership breakdown, that feels more like a top to me than a fresh uptrend. It's a lot of push and pull out there, so welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 10 plus additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly time frame. Now that the July bars have officially closed out, what do we see here in terms of candle structure and location? In terms of structure, it's a green-bodied indecisive doji. The defining characteristic here is the small-bodied bar, which of course leaves behind a larger upper wick and a larger lower wick, which just indicates that there's not a lot of acceptance at range high and range low. So bulls and bears couldn't really come to consensus. On the bar-to-bar count in terms of location, notice the lower high as well as the higher low. It's an inside bar, and we've closed pretty much unchanged from the previous monthly close. So incredibly neutral on the bar-to-bar count, and this just looks like price digestion after a record-setting rally through here after the March lows. Now, if we just default back to a higher time frame trend count, it's still up, right? We've got highs, we've got monthly higher highs. This is the monthly highest high. It's literally the all-time high. We've got monthly lows and monthly higher lows here, which means if the chart pulls back, there's plenty of room to set a monthly higher low and keep the trend in the upward direction. Nobody should be shocked if I say, hey, look at the previous all-time high retest. If the market does something that looks like that, it's the first logical place to see if buyers can step up. Of course, we are still trading above an upward sloping monthly 20 SMA, and the reason I bring all of this stuff up is because nobody should really be thinking about Armageddon outcomes here until the monthly trend flips to down, right? As always, we'll go back to the example of the dot-com bubble bursting. There's your first lower high under the monthly 20, monthly lower lows. Ouch, ouch. We go take a look at the Great Financial Crisis. Here's your monthly double top. Everything looks fine over the monthly 20 SMA up until you put in a lower high under the monthly 20 SMA, monthly lower lows, and oh my goodness, ouch, right? So we're just not even there yet in terms of having that conversation. Could that be around the corner? Anything can always happen in the market, but in terms of probabilities for August, certainly not expecting a huge Armageddon. Wow, I can't believe we just lost 50% of the market's value, right? 700 is the first major spot to start paying attention to. In terms of measured move targets in the upward direction, I do just want to reinforce, because we talked about this last month, we'll talk about it again. If we use some confluence here with this measured move from that bull flag, and now that we've got this going on, we could take this bull flag as well. If you just take a look, we're in the neighborhood of about 850 as a Fibonacci measured move. Now, once again, this does not imply, and I'm not suggesting that August needs to break out and get us there in a single month's worth of trade. That'd be insane if we did that. And, again, anything's always possible. But the idea is just as and if we move into blue sky territory, 850 is probably a level to pay attention to on the top side. Let's bring this thing down to a weekly chart here, and let's get a little bit more granular in terms of weekly analysis. As always, we'll stick with candle structure and location. In terms of structure last week, we've got much more of a bullish looking bar here. That's certainly a green-bodied, long-legged hammer candle where we know that sellers stepped up, they pushed prices lower, developing the lower wick, but of course, buyers respond and they move not just back up to the opening print, but through the opening print for range expansion in the upward direction, closing strong at the highs of the weekly range. Very impressive weekly bar here on the spiders, especially when we start considering location as well. Notice the lower high, but most importantly, look at the lower low, right? We really broke some key supports in here on the weekly time frame, and we'll see this on the daily with a little bit more nuance as well. The fact that the sellers couldn't materialize any of that downside momentum and allow for a weaker close underneath the previous week's range, it just kind of speaks volumes that sellers aren't really attacking this market in an aggressive way. Notice also this blue dotted line, by the way, is the 10-week moving average, and that of course has been reclaimed. It's the same thing as the 50 SMA on the daily timescale. So is this really still just a bull flag on the weekly chart sitting in consolidation well above a fib 38.2? I think the answer is yes for now. We're still above an upward sloping 20-week moving average, just like we're above the upward sloping 20-month moving average. Here's the anchored VWAP set for the weekly as well. We've actually reclaimed the all-time high anchored VWAP, which is great. And if we just jump into the volume profile real quick, You can see here as I zoom out and bring across our lower bound of the high volume node, we've closed above that as well. So sellers, what happened here? Again, I don't want to be like fully bullish, just remembering how this market has kind of responded to these weekly consolidations in the past. I certainly have this as an analog in the back pocket. I don't love the volatility that's going on out there. I don't love the fact that we don't have new leaders really emerging and breaking before we get a follow through day. To me, it's a little wishy-washy. I could see the bullish argument, and at the end of the day, it's the end of the day, but price is what pays, and going with price, this is kind of a bull flag until proven otherwise. Sellers failed the breakdown this week, and we kind of take it from there. Let's drop it on down to a daily chart. Let's get a little bit more granular here and start with this week's expected move. If you're not familiar with the expected move, it's this gray shaded area right here, and you can check out the video tutorial in the top right hand corner if you want more information. The upper bound is at 757.43, implying a higher high versus last week's high, and even a higher high versus this previous pivot. That's pretty bullish if you ask me. If you look at the lower bound, it's 736.63, certainly a higher low against the low of the Wednesday liquidation post FOMC, if you will. And so therefore, expected move kind of aligns with the bulls here. We're still inside of this overall range, and that's really what we just illustrated with the monthly time scale as well. But for the most part, the expected move is trying to suggest a little bit of constructive improvement here. If we're thinking about the trend also is doing something interesting. We knew that we were in this downward sloping channel right through here, certainly got way too extended on that Wednesday low. We were expecting a snapback, but what I was also expecting was a little bit of a lower high threat, like more of a serious lower high threat underneath 742. And then look at the way that Friday's bar closed, right? Just when you think on the gap down and then the sell-off, okay, here we go, the sellers, they got him, right? It's like a gap up over the trend line, come back in, close it weak. That like midday rally that just brought things straight back up to the highs, very, very impressive. The trend is broken. This is a hammer candle. Is this going to start to act as a higher low? Do we technically have a very nuanced higher high there? Even if you don't want to call that a higher high, I mean, undeniably, it's an equal high to what we have back over here. So it's just very difficult to maintain as bearish of a stance over here. Hopefully, again, nobody was getting short in the hole, but at least in here, we had some semblance of a lower high. AMD was actually a beautiful trade on Friday morning for a short. Nonetheless, the SPY index level, this hammer here has to make me think, okay, we're not bearish and breaking down aggressively. That's pretty straightforward here. We're not getting the ideal lower high. Is there still some ability for a weekly lower high? Could you make that argument? Perhaps. Are we tangled at flattening moving averages? Yes. Do I think there's a huge edge in the market here? I don't see it, if I'm being honest, in terms of directionally calling it. I want to be an optimist. You guys have heard me say this time in and time out. I want to be an optimist on the future of robotics and AI and autonomy and all of this stuff. But at the end of the day, positioning and price is what pays, as we just said moments ago. And if the trade is too crowded, if there's nobody left to buy, it doesn't matter how cool the future is and how bullish we want to be on that. We're going to need to flush out positioning. So as of now, I am under the sort of loose neutrality of the daily trend improvement and the lack of sellers being able to hold price underneath that 742. The reclaim of the moving average stack, again, gets a little something going on there. It doesn't feel like a full-blown liquidation. The volume really didn't get aggressive enough. I know Leo literally liquidated his portfolio, but widespread. It does not feel the same as, oh my goodness, here we go. The one thing that we can say is it does start to feel similar. I know this is much more of a capitulation, but it does feel similar. If you look at this bar over here, 330 is our breakdown from Wednesday, and then we have the gap up higher in range closes strong, gap up higher in range closes strong, the next day gaps up, right? So you could build this analog that if you're trying to look for a low, we're probably closer to something that looks like this. We do not officially have a follow-through day yet. This is day one of the rally attempt. This is day two. We need Monday, and then on Tuesday is day four, where we could look for a 1%. It's really probably closer to 1.5% up day on an increase in volume from the prior day's session, right? Volume down here needs to increase. So we would need to see maybe sideways or whatever here Monday, Tuesday, lighter volume here and maybe here. And then on day four, sorry, Tuesday could be the day four. Let's just say it's 5 because it could happen 4 or beyond. Day 5, increase in volume up 1.5% on the market, right? Something like that starts to look like a follow-through day, and we'll see if we can't build a new uptrend. The problem is, as we mentioned in the intro, there's like some breakdowns in leadership. Not all AI names are created equal. The market's clearly picking winners and losers right now. We'll get into those later. And there's not a ton of new bases to be breaking out of in the upward direction. That's part of it as well. I mean, volatility is still cranking. So I want to take a optimistic approach to the market, but I also want to be very open-minded to remaining somewhat neutral in here and not overcommitting on the bull side, kind of towing the line in between until we have, as much as it sucks to say, more information, right? How long can you wait? But a little bit more information would help. Let's go to the the hourly chart here and take a look at the hourlies. You can see your balance range. The opportunity for sellers was ripe on Thursday to kind of reject this, and then on Friday to come in lower high. That's what sellers wanted to see. Clearly, the close is completely opposite of that. Instead of this morning liquidation sticking, instead it was bid back higher into the close, which is a bullish sign in and of itself. Instead of that weakness sticking on the gap up and failing, no, buyers actually responded to this little block of structure down underneath us, dipping a toe into demand and being punted right back out of it. So for now, if I'm an hourly trend trader, I certainly have to acknowledge, right, that we have a trend line break here. We have the ability, now that we have higher highs on the hourly chart, let's go back to Trend Basics 101. If this is an hourly higher high, it means that if the hourly chart pulls back, it can afford a higher low. Where's the obvious higher low? Right here, right? We do something that looks like that, and we're off to the races. Could you argue that this is already the hourly higher low? Absolutely. But as a structural block at this point, I'm really just paying attention to that 742. As long as price action can remain above that and build something out, this to me really starts to put the pressure back on in the upward direction. And perhaps, pattern traders rejoice. It's a major inverted head and shoulders, something that builds out like that. Who knows? Time will ultimately tell, but 742 is that key level. So in terms of pathing early this week, if the market's going to remain, somewhat bullish here, fine, pullbacks can come in, but 742 is kind of our short-term line in the sand. Ideally, we do this, and then that. Problems would emerge if we Brigade bolt back underneath. This is going to look like a nasty overshoot. And if that happens, let me be very clear, this would be a sign that with all the volatility, the push-pull, up, down, oh my God, it's saved, it's the end of the world, it's bullish, we're going to highs, we're going to lows. With all of that, that's hallmark of bear market volatility. In my experience, and a lot of people talking about this as well online, if I could speak, is the 2022 bear market analog. The nasty counter trend bear market rallies were rip your face off rallies, right? And this is a rip your face off rally over the last handful of days here in the market. So back underneath 742, if this thing's starting to push the lows again, I think we kind of have our answer. We're churning, we're volatile, we're violent, and that's a little bit more characteristic of bear market entrances rather than we're going to sustain and drift into a nice uptrend. The other thing to just pair with it is what's going on with interest rates. Is Mr. Kevin Warsh ultimately going to have to raise interest rates? Well, the 10-year is telling him to, the 30-year is telling him to, the 2-year is telling him to, and yet he does nothing. So if we're going into a rate hiking regime, is that similar to what happened in 2022? Just to continue to draw some comparisons, I think the answer is yes. I'm not saying he has to do that, but I'm just, again, trying to weigh the situations that we're headed into. Rates are certainly a headwind right now to the market. So that's that. If the market tries to rally first, let me be clear about this one. If we rally first and then pull back in, that's not the end of the world, right? You can rally, fail that, pull back in, and this is still your hourly high or low. And heck, if the market's going to go, I wouldn't call this gwagged fee, but if we were just going to continue for something that looks like that, color me impressed. I'll put a little asterisk on that one. I would tend to think there's lower odds of just doing something that looks like that. But if the market does it, then hey, you got to kind of take that at face value. And again, price is what pays. Something over this left side peak, 749, back into this upper block. It's pretty impressive improvements from the market should we start to see higher lows above. So bottom line, I know it's not the answer that people want to hear. We haven't really had that answer that people want to hear for a long time now, as this market has found itself in a range ever really since June 5th. But it's really take it day by day. Don't overcommit to either direction. And that's the edge in and of itself. The edge is not being married to needing to see prices go lower, needing to see prices go higher. If your foot is off the gas pedal, if you're doing less in this environment, you could short-term trade the heck out of this market. That's absolutely, take advantage of the short-term volatility. But for anybody who's like really taking a higher time frame approach to the market, trying to figure out, okay, what direction are we going? Instead of trying to short it down here, and then you're like, okay, that didn't work. I stopped out. It must be bullish now. And you buy it back over here in your max port long, and then this is going to stop you out. Doing too much of that, all of these paper cuts, if you're trying to like medium time frame swing trade this market, less is more in this environment. And I'm sure you figured that out by now, but that continues to be the case after the failure of the downtrend to materialize a lower high and lower prices into the end of last week. Let's clear this up. Let's go ahead and drop in our intraday anchored view apps just to get a sense for what's going on from this perspective. A couple of things I've adjusted in here. I've just made the all-time high anchored view app the red down arrow. This is the April gap up, and that is the low of the March, this green arrow back over here. The ones I would like to focus on are these two, right? This is the FOMC anchored view app and the gap down anchored view app from Thursday of 2 weeks ago now. Those will slowly start to play confluence here at 742. So if this if this level is confluence with those anchored view apps, as and if the market pulls in, I would pay attention to that, reclaiming the majority of the stack, the all-time high anchored view app, and the most important one, the FOMC anchored view app, right? If we could stay above that 742 with confluence, that looks pretty darn good to me. Let's go ahead and drop in a Fibonacci pull from the low up to the high. And would you look at that? Just 38.2 right in the neighborhood of 742 is just reinforcing that level. So the biggest thing I would say, if we're just going to boil this analysis down to one thing, does the market stay above 742 next week, or does the market break back down below 742? That kind of holds the secret, in my opinion, as to where we go from here. Above and we're neutral to bullish, below and guess what? We're getting we're getting pulled in every which direction, and it's violent and volatile, and that's more hallmark of a bear market entrance, right? Let's clear that up. Let's go on from this hourly chart to some supporting evidence, starting with, of course, our market internals. If you're not familiar with the internals dashboard, check out the video tutorial in the top right-hand corner. You can see here that the volume flows really weren't all that bad or impressive on that Thursday-Friday combo. And the problem here, right, is that, yeah, it's a strong rally on that Thursday session. Look at where we closed on Wednesday. This measures from a previous day's close, mind you. So you see where I'm going with this, which is why I'm not like full bore bullish, oh my God, we're going to the moon and everything's great. The volume flows were not impressive, right? Not at all. It looks like a counter trend rally in the context of a break as of Thursday's close. And then Friday's close, they're not even volume flows positive here on that V-shaped reversal. So just to me, it's not as pretty as it looks on the daily time scale. You know, I need to be neutral based on the location of price. But if I look at supporting evidence, I'm kind of thinking to myself, I would not be shocked if that 742 level, just to go back and look at it, I would not be shocked at all if this breaks back down and we do something that looks like that. This is not going to be a shocker, right? 742 is critical for all the reasons we've just identified, but you know, if we're below it, okay, so be it. It makes sense. We're not seeing tons of volume inflow, not seeing it here. And, the NASDAQ's, of course, a little bit different. But here you go. Your advanced decline line, Thursday, Friday, not really impressive on the 2-day rally. And then your cumulative build, I mean, we're not even over 5,000. We're not even over 2,000 into the close there. You mean to tell me after such an impressive back half of the day rally, the cumulative tick, which measures tick by tick every 3 seconds, you mean to tell me we're sub 2,000 on the cumulative tick at the exchange level? It's just not really, a full bore bullish picture as we rebound off the lows. It's a gnarly snapback is kind of what it looks like, which happened to reclaim some really key and important structure. As we jump on over to the market profile, if you're not familiar with this, check out the video tutorial top right-hand corner. What do we see here? Certainly, value did not shift lower on Wednesday. That was one of the tells we talked about on the Wednesday midweek market update. We do still have a poor low on the Thursday session, ADE periods flat across the lows. And then on Friday, value did shift higher, as did the point of control. To me, yes, it does indicate price acceptance towards the top of the range, but it also indicates any semblance of a gap down on Monday, any weak open. All of these buyers who are trapped here at the highs of Friday's range, this is going to be easy to topple over. The toppling over effect, as we like to call it, the Jenga tower effect, if you will, is going to be much easier because the point of control, people are net long from terrible location as of Friday, right? So that's interesting to me. And if we pull back, once again, we'll just have to judge what happens at that 742 spot on the Spider's Cash. Let's go back on over here. Let's give this a little reset this way to a monthly, and let's go to the Qs. And let's take a peek at our clean drawing set and what we've got from a monthly perspective on the NAS. Much gnarlier of a picture. I mean, look at this bar on the July timeframe. My goodness, a solid red-bodied bar with just a little bit of a lower wick relative to the size of the body. This is not an indecisive doji. This is a much more compelling downside-looking bar. Yeah, sure, you're still in a bull flag up here, but you've got yourself bar-to-bar lower high and lower low. Candle closed just slightly inside of the previous month's range. This is still the highest high of the monthly trend count, so I maintain all the same comments we've made on the S&P 500. We could afford to pull back, set a monthly higher low. We're over an upward sloping 20-month moving average. Things are still fine from that perspective, but boy, oh boy, the candle structure is notably different over here thanks to the just weight of tech over on the NASDAQ. I mean, it's a tech index, right? Versus the S&P, a little bit more well-rounded. Let's go ahead and take our Fibonacci measured move pull here. We've got two of them to pay attention to. 800, the round figure, is the larger flag, like if this is still sorting out its measured move, that's your 800, excuse me, and then your slightly higher measured move is going to be up there at the 850 spot. So 850 is your short-term bull flag here, your high tight, AI recovery flag, if you will, and then this one is your major tariff low flag measured move into 800, 790 technically, if you want to split hairs over there. Let's clear that up. Let's go ahead and, I don't think the NASDAQ even goes back. Yeah, it does, I guess. Goes back far enough. The 20 SMA is hard to see prior to that on the QQQ. The NDX would be fine, but there's your monthly lower high, break of the neckline, ouch. That's when the dot-com bubble bursts. And once again, could this end up being like that? Sure, but we'll deal with that when we're here, not when we're here. Right, that's my approach, at least in the monthly timescale. Let's drop this thing to a weekly chart, and let's take a peek at this. Whoa, all sorts of funky zoom on Thinkorswim. You gotta love it. What do we have in terms of candle structure and location? You've got yourself a long-legged hammer, just like the S&P. However, it's a red-bodied bar. We do still close back inside the previous week's range. We pierce the weekly 20 SMA and do not close underneath it. Notice, though, that we are still underneath a declining 10-week moving average, aka 50 SMA on the daily time scale. In terms of bar-to-bar count, lower low, lower high, and for now, this is a weekly downtrend. You've got yourself highs, you've got yourself lows, and this undeniably is a lower low. Is it short-lived? Probably could be short-lived. As Powell used to say, short-lived. Could be short-lived if we break that hammer high and start doing something that looks like this. The big reclaim level right around in here is the main focus of the daily timescale. As we know, it's right around 699. So that's that. Let's take a peek quickly at the fibs, just see where that lower wick landed, because we did make a substantial low. Still over the fib 38.2 in terms of a close. We did not tag the 50% retracement and still interested in this, about 640s, if the monthly chart needs a deeper pullback than what we've already experienced here on the Qs. Let's clear that one up, and let's take a peek at the, we'll go with the anchored VWAPs on the weekly first. We are not over the all-time high anchored VWAP. We are back above this after piercing it in the lower wick. That's the March lows anchored VWAP. And what about the volume profile? Where are we versus that high volume node? This one right over here, still well below at this point. So the NASDAQ clearly has a lot more work to do. And as we made mention, the market is picking winners and leaders, and winners and losers, I should say. And winners and losers. And a lot of the losers are in the NASDAQ space, right? The big banks right now and the financials, they're kind of pulling a lot of weight for this S&P 500. We'll get into the sectors in just a moment. But for now, let's go back on down to this Q's daily time scale. Let's throw on the levels here. The weekly expected move is up first. Here we go. You've got yourself an upper bound around 706.47, and that, of course, is a higher high versus last week's high, but it's an equal high to what we have back over here. And if we look at the lower bound, it's 669.51. That's a higher low versus the Wednesday low from last week. But generally speaking, it would keep us in a downtrend if we did move there and just kind of rejected early on in the week, did something that looked like this. This is just a lower high in the daily trend count. So a bit more neutral on the Q's daily analysis here in terms of expected move analysis rather than the S&P, which is a bit more optimistic, if you will. I do like, and this is that level we were just talking about, so I apologize, it's technically not this one up here at that 699.700 spot, although that is an unfilled gap, but this weekly low set, right? Boom, 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 and boom. That level there at 680.650, we closed ever so slightly above it into the Friday bell. I think that's a better sign. It's more bullish than it is bearish, of course, but I'm still not convinced here on this chart, right? It's almost like we have the inverse of this. 3-day bounce right into a declining moving average. 3-day bounce, a little bit more violent through the moving average, but maybe this time it's the 20 SMA, right? Maybe it's this time you reject this overhead supply and the trend remains down. So as much as I'm trying to neutralize in the S&P 500 and not be overly bearish, and it never makes sense to be bearish in the whole on that S&P, on the NASDAQ, it's a slightly different story, and honestly, I'm not going to be afraid to look for lower high shorts against this gap fill reversal, that 699, 703.25 spot, 20 SMA. If we can reject that on a little counter trend relief rally bounce, yeah, that would make a nice spot for risk reward shorts to do something along these lines and get back down, even if it's just to this weekly low again. And then if runners go beyond that, it doesn't have to be you're short the NQ or you're short the QQQ for this exact thing. You could just trade this or express this as a range and a bias, directional bias overall for the market, right? So that's my idea here against the overhead gap and the 20 SMA, looking for a lower high rejection there. If the market does move lower in here, in the short term, could we do something that looks like this and then I'll change my tone? Perhaps. Will I be using the follow-through day rules? Probably. This is day one of a rally attempt. Day two, we talked about it on the S&P 500. I won't rehash the whole thing, but on day 4 or beyond, if we can get that plus, I'm just going to say 2% on the NASDAQ, because my God. And that's from the previous day's close, not the opening print. Plus 2% move or more on an increase in volume. I just said I wasn't going to rehash the whole thing, but I basically did. Then fine, maybe we're looking at the follow-through day as a potential way to get involved in longs, in which case you would need to hold the low of the follow-through day and not take it out. If you do, then good night. You're probably drifting into that more aggressive bear market, right? So the trend is down. I'm a little bit less bullish for, I think, reasonable reasons on the NASDAQ side of the market. The S&P a little bit more neutral, and I could see the path forward to bullishness if we drop it on into the hourly chart here. Yes, short-term hourly trend has changed back to up, right? If you could do this, you're breaking the not neck, but just the trend line there. And you've got lows, you've got higher lows, higher lows. And if the market's going to sustain that, I would say we can really afford to go no deeper than the equivalent level, which is going to be your scene of the crime spot, basically, the FOMC highs, Wednesday's highs. That's 676 on the QQQ. If we hold that for a higher low against this, that kind of starts to shape us up for the inverted head and shoulders, or just starting a new trend count in the upward direction. The ideal reclaim, though, and substantial hold above is this 686.50. So let's just get back down to business and talk about what does the pathing look like. We know where the trend inflection points are, but what's just the final say on pathing? We open here and rally. Okay, I'm looking for shorts against this area, and I'm doing something that looks like that. Risk, reward, back into here as a general idea for the market expression. When we get here, we have what I've been calling a junction box recently, right? If you hold that for a higher low, great. Maybe we have our follow through day. We use this as a higher low and we trade against it. If you come out of the junction box to the downside, forget about it. We're just increasing or trying to increase the bearish pressure on the market there, losing that key weekly spot and probably looking for lower. And honestly, if it's just straight down, like something that looks like this, you might pit stop here. And then your idea would be let it go counter trend for a day or two, or maybe intraday, it's just an hourly string of bars to the upside. Then you reattack it here for downside that looks like that. If the market opens and drifts to the downside first, the big spot is here, right? And this honestly could be a junction box as well. 676, that would be my first thought. Can we sustain that higher low? Bulls would want to see this to then start realigning with that upside there. And then if it's bearish, right, you just realign with that. So it's the same junction box there. This is the most bearish outcome. Forget about it. You know, good night, sayonara, nice knowing you. Underneath 676, all of this fails. Everybody, and think about it from this perspective as well. Think about it from a positioning point of view. Anybody who saw the gap up on that Thursday morning and bought this long, and you know, not even the NASDAQ, but bought MU, bought SanDisk, bought all of these memory names, the high beta AI related names, NBIS, Bloom Energy, all that stuff, right? Anybody who bought that on the Thursday open, those people are underwater if we lose 676, which is why that's such a key level, right? That's kind of the pathing ideas to start, and we'll take it in stride from there, but I do believe that more of a bearish bias, if the market rallies into this gap, is warranted underneath the declining 20 SMA, alongside just overall evidence that to me supports more of a counter trend snapback being all we've experienced so far, rather than an okay, coast is clear, let's rock and roll to the top side, right? That's that. Let's drop in our anchored VWAPs from an intraday perspective. Doing this, you can see the spread is so much wider on the NASDAQ side, and for good reason, right? You're in a more trending market. You're not as compressed, so you're underneath key anchored VWAPs and key moving averages for that point. But you've lost your April 8th gap up anchored VWAP that did act as resistance on Friday. If we once again rally into this, fail, you could use that as an entry tactic. Getting a lower high back down underneath that could set up the short to get back in the downward direction. You get into here. You break, you're holding underneath, this is going sideways like that. You could use that as an entry tactic. So it's not only just a lower high underneath the weekly low set, but a break of the March lows anchored VWAP could do it, alongside the Thursday gap down anchored VWAP, heck, even the FOMC anchored VWAP. So there's a number of ways to use these things as additional confluences or trigger points for your entry tactics. But generally speaking, not nearly as bullish as the S&P, and I think that's fairly straightforward. The idea, sound like a broken record, I'm sure I'm just repeating myself now, but here, right? This, ouch, this maybe holds us up. And then if you do that, good night, nice knowing you. So just looking for lower highs, really looking for a lower high turn. And if the market's going to, prove me wrong and become more optimistic, bare minimum has to hold this. That's like the final line in the sand. If we cannot hold that, then these buyers are underwater from Thursday's move higher, right? That's the premise there. We could throw a fib on it. Why not? Just to be congruent with the S&P from the low of the move up to the high of this most recent. And the fib 38.2 is not really confluence with anything, but the 61.8 in here is decent. It's close enough to that 676 that it would make me think, okay, if we're over that level, then, we're kind of holding the line in the sand fib. If we break it, it's a different story. Let's drop into the internals. What do we have on this front? Once again, Friday, you mean to tell me that we close strong like that, after this dipsy-do off the morning gap rules? And think about it this way. I didn't really dive too deep into the bar to bar, but Friday, you get a gap up. If you're a buyer, you're like, let's rock. Let's go gap fill reversal. Let's go. You didn't really get that. So sellers have, oh my goodness, look at this, lower high back in range. Let's push it lower. You didn't really get that either. So the push pull is there, and we default back to like some additional data points. We go here and we're like, all right, the volume flow really wasn't that impressive on that Friday session. If we look at the advanced decline line, it closes terribly. If we look at the cumulative build, it's red. Right? So the more you look at it, the more you're like, yeah, it was a nice 2-day bounce and a lot of it happened overnight, but is the market really getting healthier here? Or are we building a constructive look for higher? I don't fully see it on the NASDAQ side of the market. Let's just check in with the market profile here for the NQs, see what we got going on. Let's scrunch this up a little bit. That'll do, I guess. Value moved higher. This is actually interesting. The value area did not shift higher on Friday on the individual range. So yes, value higher, as I said here, but not on the individual session. We just have this B-shaped profile. What does that look like? Or what does that typically tell us? That's liquidation, right? That is long liquidation. That is not, a constructive look at all. So I think it's a little bit more dangerous over here on the NQ, and you could see it in price. You could see it in the market internals. I don't think I'm telling you anything you don't already know. Just identifying the levels and maybe reinforcing it. This doesn't look good. It looks like a lower high trying to be set, and I'll only change my tone if we firm up the higher low and start to go. The thing about it too is, let's just go back to this daily chart. If we're thinking that this is going to be constructive and we're going to get a new all-time high out of this and the market's going to, go on to rally and produce this big second leg weekly bull flag breakout, it's okay if you just take, I don't know, how many days is this, 3-4 days or whatever, 5%. I'm willing to sacrifice 5% off the dead low to get confidence on a higher low, building the trend for what may end up being a 10+% rally to new all-time highs, right? It's okay. And, power to you if you can nab the low over here. I know some people do, but, for the folks looking for the confirmation, it's the same thing that happened over here, right? Sure, if you got the low, you're feeling like a hero, but, this entire rally is 34%. If you waited for the gap up, which was the follow-through day, basically, that rally was 24%. So yeah, it's 10% less, but you're not no worse for the wear if you're going and trading leaders anyways. So those are some comments on this QQQ. Looking for the turn down here. Seems to be what a lot of people are looking for. Do we go higher back to all-time highs? I'm not fully convinced. Maybe I'm too skeptical. I want to be an optimist, but you got to show it to me with price and structure first before I'm going to jump in the pool with everybody else. Let's go ahead and jump into the IWM. Speaking of jumping into things, what do we got going on over here in small cap land? Got ourselves a monthly. It's not technically an inside bar because that wick does break the previous monthly high, but it's not really a range expansion bar. It's a resting bar, if you will, after this really substantial breakthrough here. It seems reasonable that this IWM could rest on the higher time frames. I'm not overly concerned with the look of this monthly chart. If we pull back on the monthly, there's room for that monthly higher low thesis. No problemo. Let's come in here with a fib just because this one's a little bit more relevant on the higher time frame for the IWM, not so much on the others, right? We do that on the weekly, but there you have it. That's fine. The 50% retracement if we were to come in a little bit deeper. And then what about this one? Here to here. 38.2 is a little bit deeper than that. Just be curious to see when and if the 38.2 eventually comes up to be confluence with that spot. Anyway, that's the monthly look. The trend, of course, is up. We could afford a higher low pullback. There's really nothing to look left to over here. Or over a monthly 20 SMA, a bit more extended from that monthly 20 SMA than some other moving averages on the Qs, for example. Let's drop it on down to the weekly chart and see what we got going on over here. It's a very controlled pullback, as we know. It's been a very difficult, I shouldn't even say difficult market to analyze. It's been not really worth our time to spend a ton of time, literally, on analysis for the Russell. You're just, what are you going to analyze in here other than you're just in a little controlled downtrend? It's fine, right? There's no big tell here on the IWM. The moving averages are incredibly tight. If we could break a trend line, then sure. If we can't break a trend line, then so be it. But yeah, I don't think there's a lot to talk about over that. and maybe we get going back towards the highs. I do like, and we could look into this a little bit, the lower wick of the Friday session, 288.50s. We swept the Wednesday low and were able to see buyers step up, scoop it up, and close midpoint of that range. So not terrible. Buyers stepping up. It's just basically use Friday's range. Over the 20 SMA bullish, under to Friday's low bearish. That's it. That's it. 292.50, 288.50. Anything interesting on the hourly chart here that we care about? Survey says no. It's just a range. So the biggest interpretation would just be if the market was truly fearful about rate hikes from Mr. K-Dub, then why is the small cap market not falling off of a cliff? It's not. So small caps are telling us maybe, don't worry about the 25 basis point hike. He's just going to let the 10-year and the 30-year do its thing, and whatever happens with smalls is going to be mixed and mild, right? No big reason to get overly involved in that. So don't have a ton for you on this one. Just keep it simple. Let's go on over to this Russell on the internal side. Volume flows technically out, lower high here under the zero mark, bullish on the cumulative build. I mean, what do you make of that? That's just very, very neutral action here out of the Rusty as the chart actively looks like this, right? So all I can really do and say is watch this 288.50. If we break that, yeah, a bit more of a headwind for the broader marketplace overall. Let's jump into the market profile for the RTY and see if there's just anything to glean from this perspective. Value's unchanged through these sessions, right? So you get value, value, and value unchanged on these small caps, which, some of those names that were in Leo's portfolio, some of those high beta tech names, they are smaller cap names. So to see this kind of going sideways, not snapping back more aggressively, seems to me that our little snide remark in the intro about, is it high beta confidence or just a quick buck for Kenny G? I think it's just a quick buck, right? It doesn't really seem as though this thing's aggressively trending higher here on the RTY in terms of pushing value higher in that session. Let's go back on over to the spiders. Let's have our conversation about the sectors and the rotation under the hood here for the market. If we take a look at leadership this past week, we of course are pushed higher by IGV, software names. You could thank Microsoft's gap up for that. and there's also honestly some others that look really good in the software space, but this XLY is performing well. We've got MAG7 ETF up PI on the week, 3.14, XLE lighter weight defense, inflationary, I should say, not defensive. Staples defensive up 75 basis points, communications financials. Bottom of the barrel is over here in your DRAM, so your memory name still down a whopping 8.28% on the week, even after the massive rally from the Thursday gap up. SMH, no hiding over there. Utilities down. That's interesting because it's a risk-off sector. Industrials, no hiding there, down 2%. So really, really aggressive moves in both the up and downward direction. Once again, this big push-pull, this tension, this rally higher, rip it back lower, back higher, back lower. It's hallmark volatility of bear markets, right? Let's jump into these individual charts and see what's going on. IGV looks phenomenal here. Maybe I shouldn't say phenomenal, but it looks constructive. How about that? If you get yourself a higher low double bottom, is this neckline going to break? Are we going to reclaim the 200 SMA? Is this good volume coming in here a good sign to start seeing something that looks like this back up towards the highs? Certainly would be constructive. We'll watch out for that. This 96.4 spot is a big level acting as the neckline of that higher time frame double bottom picture. And even if you just wanted to take the approach of, okay, here's a balance range above, bears should have done this. No dice. Bears, what's going on? Where is your lower high Brigade bolt underneath? The overhead supply didn't happen. Let's jump on into the XLY. What a miraculous save. I mean, my goodness, Amazon coming to the rescue, huh? Big old balance range, gnarly gap down, only to be reclaimed right back to the midpoint of the range. So XLY, just kind of, it is what it is. It's back in the chop and slop. We got to give it some credit for the amount of distance it's traveled, but higher lows are absolutely the thing that need, not like, okay, maybe, they need to be preserved over 113.40 if this is going to remain constructive for upside. It's going over the MAG7 ETF, another one that I'm just like, wow, I mean, talk about just rip your face off style moves. Here's the gap down, which everybody's like, oh, geez, here we go, right? And myself included, we go from this constructive, really nice look, okay, here we are trying to reclaim the moving average stack to, okay, that sucks. And then, okay, we're breaking down, and then right back higher on earnings, right? So the push-pull is real. It's very violent, very volatile, but we are higher, and the idea now is to say, okay, is Amazon, is the MAG7 complex ultimately going to be strong enough to lift the market higher? If it is going to be the case, very obvious, right? Very clear what needs to happen. You cannot afford any lower lows underneath 64.25. If you break that level, it's good night. Well, I shouldn't say good night. You're on notice if you break that level. You break this level, 62.85, on a deeper retracement, good night. Nice knowing you, game over, right? Let's go over to the XLE. This is looking like it's higher out of a little flag through here. I'm not a fan of energy. I've talked that thesis into the ground on the channel, so be my guest if you want to trade headlines. Not for me. XLP, staples back in the range, failing to break out here. I mean, this is a defensive sector, so a failed breakout's technically a little bit more bullish for the market, right? Or at least less concerning, I would say. So that doesn't look half bad. Let's jump into the communication sector. This is gnarly. This to me is sign me up for 2022. This look at this. I mean, what is this? Is this Swiss cheese? Gap down, gap up, higher, gap down, back. You can literally hear me at a loss for words. What do we do with that? What is anybody doing with that, right? So be my guest if you're trading it. You do your thing, but I don't know about you. Zooming out on this chart, I see a series of highs, lower-ish highs, lower high happening here, lows, lower lows, lower lows, lows, lower lows, equal lows in here. Looks bearish to neutral at best. I would not be all bulled up on a chart that looks like this. Oh my goodness, this is a train wreck on that XLC. So thank your Googler for that one. Thank Google and thank, of course, Meta. Just push, pull, both opposites, right? Let's go to this XLF. Financials look great, holding up over the daily 20 SMA. Looks like a great higher low, bull flag here, new all-time highs. That rotation will keep the S&P 500 a little bit more resilient, as we know. Let's go on over to the DRAM chart. Once again, I don't want to be any more bearish than I have to be, but does this look like it's been repaired? I don't think so. You're still under your neckline over here if you want to draw it that way. Everybody who, and myself included, was looking for the inverted head and shoulders, the oopsie daisies, right? The oops pattern. It didn't really show up out of this 3-day range. Instead, we got the Leo liquidation, just pushed back higher, and now we're just getting slapped off a daily 20 SMA under 55, a nice round psych number from back here on the breakout. It looks like a continuation of a downward trending channel, right? If we do something that looks like that and like this, it looks like a trend channel. So I don't know how we could be jazzed up about this until there's a clear higher low over 55. Once again, I would love to be bullish the AI super high beta, oh my goodness, memory trade like everybody else because it was so fun on the upside, but you know, geez, the music stops at a certain point, right? Unless we can reclaim that 55, I think that we're in store for a little bit of trouble here on this DRAM. The only other thing to say would be if you do not make a lower low, if this market is incapable of making a lower low, then okay, maybe we're just hanging in sideways. And you know, I'll also acknowledge, let me just break out the measuring stick. This thing is down, right? It was down 38% from the highs. You can't just keep having, we talked about this before, you can't just keep having down 10%, down 15%, down 10% days over and over and over and over again. The next thing you know, you're going to be at zero. So for now, I can't be overly bullish on it, but I don't know if it's going to go terribly lower. I think you could get sideways in here, incrementally lower, something that looks like that. And I would, you know, that would be acceptable. If we are going to be higher, though, that would be like color me impressed and take notice of a move over 55. Such an important sector, or it's really a subsector at this point, sub-industry group for the market at this point. Here's your SMH, another one with a very well-defined, okay, there, you know, we were supposed to, quote unquote, we were supposed to get the oopsie daisies right there, and instead we got a lower low. We're still underneath that 568 spot. So is this anything more than just a lower high? You know, and the more I look at these, because we all know that semiconductors were responsible for driving the market higher off of the March lows, the more I look at this and not just at something like the SPY, the more I think to myself, geez, you know, I want to be an optimist, but we're just in a downtrend. And like maybe these things go sideways. Maybe they do this or whatever, but I don't know if you're just going to V right back up to the highs. It does not feel the same as over here. This was not only just longer in terms of duration, but this was like we had that fear catalyst as well with the war kicking off and then the resolution, right? So that's the note on SMH. It still looks like a downtrend. This just looks like a lower high to me. 568 is your key level. Let's keep moving. XLU breaking down from this, kind of like the XLP. This breaking down doesn't concern me all that much because it's a defensive sector. So is what it is. Let's go over this XLI. This is a little bit more concerning. It's 8% of the marketplace, so don't love that. Let's jump on over to materials, middle of the range still. Not much commentary on that. It's a lightweight sector. Real estate, I'm so impressed with how real estate has held up over here. Maybe it's a good time to sell it all if you've got it, because rates, they don't seem to be slowing down. This is... or maybe that means it's a good time to hold your real estate and then sell into the rate cuts when property values ramp to the top side. Just a thought. Real estate, it's in the middle of the range. It's a lightweight sector. Let's move on. XLK, what do we have over here? Impressive little recovery back over this level. Like, you mean to tell me we have this descending triangle and we're just going to go 1 day underneath it, 2 days underneath it, and then we're going to pop back above? I'm not fully convinced for all the reasons I've described thus far across all the other things we've looked at. It, to me, is just a lower high against a trend line at the 20 SMA in a downtrend with lows, lower lows, lower lows. I want to be an optimist. I really, really do, but you've got to show me some right shoulder and a reclaim if we're going to start looking for higher. Change the trend with a higher high. Get out of the trend channel before I get bullish here. I'm not getting bullish right at the top of a trend channel. Not going to do it, right? It's a great spot for a lower high. Just like I don't want to be bearish at the bottom end of a trend channel. Don't want to be bullish at the top. So we trade in between as of Friday. We tag the top. Looks to me like you could pull back here. And any acceptance, let's just frame it this way. Any acceptance underneath 171.50s, good night. I don't see a way in which you could not retrace this further into this consolidation, right? Let's move forward to the final, last but not least sector, which is the XLV, healthcare. Island reversal up here off of these highs. This is just dojiing out in here. Higher lows maybe, coming from the highest high, give it the benefit of the doubt. Perhaps. If the AI trade continues to get stomped, maybe it's a flight to safety over to healthcare. It's a nice uptrend. I think financials have been pulling the weight a little bit more cleanly, though. So XLV, XLF are the two sectors to watch outside of the high beta momentum stuff. Let's jump into the ratio grids. Let's see where we're at with this supporting evidence. If you're not familiar with ratios in Thinkorswim, check out the video tutorial in the top right-hand corner. This is not helping, not hurting too much, but certainly sides more so with not helping because it's in a downtrend, obviously. This is good. Financials over the 50 SMA. Improvement with the spike higher, but not all the way out of the woods yet, still in a downtrend, and this is just not overly helpful here, rejecting the 50 SMA. I'd be neutral on this, I'd be neutral on this, I'd be neutral on this. We're not fully risk off, but we're not everything's fine risk on, right? That certainly seems to be the case as of right now. Yeah, it's not full-blown risk off, as in those names aren't like really doing anything crazy. XLU primarily, XLP. But we're not risk on, right? That's the interpretation. Not much. I thought maybe more would have changed through last week, but it's not the case. Let's see if the AB sets are maybe a little bit more, not shaky, but things to make note of. No, same. This is same and bearish. This is same and bearish. Sharp move higher, but still a lower high, right? And this is just sitting on a lows that's bearish. This is in a downtrend that's bearish. So you risk off through some specialized ratios, which makes more sense. This stuff is really comparing some higher beta stuff. If we jump on over to the gold ratio, no break of the trend line, or neckline, excuse me, but if it does, that's risk off. Bitcoin not telling us anything impressive. This is cool. TLT ratio made a new high. TLT got smoked on Friday. If it opens on a gap down on Monday with an uptick in implied volatility, you'll hear me talking about short sales on TLT puts. That's an interesting idea. IV really needs to get cranking, though. Copper starting to hold in there, right? It's still stacking these higher lows up the right-hand side. It's the price action, not the white line on the screen. So I like that. Dr. Copper's trying to remain resilient. Let's jump into some dollar and interest rates. Dollar falling off of a cliff with the yen intervention there. Rates going the complete opposite direction. This is interesting in the sense that if you ask different, because I sort of scratch my head here. I'm like, if rates are higher, dollar should be higher, right? That's typically how that should go. It makes you think, and if you poke around online, it is kind of the market saying we might have a credibility issue. Right? We may have a credibility issue with a weaker dollar and higher rates here. That's kind of interesting when you consider what happened through the FOMC press conference, but I digress. Let's go from there over to the inverted ZT, which is still telling us that, yeah, we might have to hike, right? Kevin Warsh may have to ultimately hike, which is shown over here as well on the probabilities tool. If we just jump into that, there we go. You've got your 67% chance of a hike in the next meeting, which of course is not August, but in the September timeframe, September 16th. And then instead of 2 hikes, it's looking, all right, no, sorry. This is 1 from where we're at to here, and then there's 2. And then we're just higher for longer. which is certainly interesting and aligns with what the 10-year is doing, but does not align with what Mr. KW has actively said in the meetings. The other thing that is going to be very notable, it's not this week, this upcoming week in terms of the economic calendar. You could see we have our full Monty labor report down here Friday, August 7th, 8:30 in the morning. We get our hourly earnings, we get our non-farm employment change, aka NFP, and the unemployment rate. That's cool, but what really matters, or what I think is going to matter, is the CPI print coming out on Wednesday, August 12th. And the reason for that is if we open up the folder, go here, and I don't know, it should be broken out here. Yes, this is what matters most. See this string of data right here, 0.6, 0.3, 0.1. Shelter inflation has been moving lower, and that I think is going to give Kevin Warsh the leeway to sort of say, we don't want to move prematurely into a crude oil shock in case crude does end up coming lower again, in which case we'll look like dummies having higher rates and shelter prices not really being an inflationary pressure. So that's the argument I see here for just staying steady, not doing a ton of stuff, and just kind of reducing intervention with the interest rate, as Kevin Warsh basically said, I think on Friday, is considering going down to only 4 meetings per year quarterly instead of the 10 meetings that they have per year currently. He first day on the job, hey guys, I want to work less. Okay. Let's move forward from that over to before we move forward, let's just make sure everybody's on the same page. I went fairly quickly. Monday, ISM manufacturing PMI in the morning. It's interesting, but the services PMI is usually a bit more important. This one over here. I know this isn't, I beats me why Forex Factory has services PMI in orange and the red for manufacturing, but that is what it is. Jolts on Tuesday, ISM services Wednesday, Thursday's pretty quiet. Your usual jobless claims, that's fine. But the full Monty labor report is on Friday, of course. Let's move forward to the earnings calendar, a loaded week with some of the smaller names out there. I mean, just throw a dart and you're going to hit something that's interesting on here. Palantir, of course, Sterling Infrastructure, Clorox Company, not. What else? I mean, again, just throw a dart. You're going to hit something interesting. Caterpillar, honorable mention. Mickey D's, Hut 8, what else is out here? AMD, how could we forget? SpaceX, Arista, A-Labs, right? Open Door, drones perhaps coming back to life. Eli Lilly Shop. You could just pause the video. My main watches, if I just had to boil it down to a few, probably actually this. Right there, right here, right here. Interested in this, but we'll see. And then Datadog, because it's been such a strong chart recently. And I think that's mostly where my focus would be. Honorable mention RCAT. Nuclear's not really in play. This Take Two, maybe. Software's going to come back. That's it. Hut 8, honorable mention, sure. We'll go there as well. All right? That's mostly where I'd be at from an earnings perspective. Speaking of earnings, the market's not falling because earnings estimates are going down. The market's falling because it doesn't know what to make of these rates, which is just, I don't want to say it's insane, but look at the earnings estimates here as of right now that we're through a majority of the Mag 7s. Look at this bump in 27, bottom up EPS, huge bump higher on those earnings. And then you scroll down, I mean, you could see the bar chart in here as well, right? That's cool. But go even further and you start looking at the PE ratio, and it's lower because 10-year rates are higher. And so I look at something that is along these lines, and I ask myself the question, what happens if rates come down? What if the crude oil situation gets resolved? What if Kevin Warsh is like, yeah, we're just going to pause in the next meeting as well, and we're not going to hike, even though the market's saying hike, we're not going to do it. And they pause. Well, you might say, okay, the Fed credibility is blown and forget about it. But if PE multiples go up because rates come down on top of this, and please, I'm never trying to go full macro, so you please tell me if I'm wrong, anybody who's more of a fundamentalist out there. On the backdrop of earnings estimates that look like this, what? Yeah, the market's probably going to new highs, right? All you have to do is kind of look at these situations where your earnings estimates go up, through here. This is the war tensions, and we can't figure it out. This is the makeup effect, this triangle, right? That's the delta in terms of the speed of the rally that we saw when everybody's like, oh my God, I can't believe how fast it was. Yeah, it's because you're making up this triangle, right? This has nothing to do with companies' earnings. And suddenly, when everything's resolved, or at least the market thinks we have a resolution, you got to make it up, right? So are we going to be in store for something similar if this market heads south from here and earnings estimates continue to move higher? it could be the situation. Maybe it's like a fundamental repricing if rates come down could be the thing. So just the thought. Again, never go full macro, or at least I try to never go full macro. But that is pretty hard to ignore when I read through this report on the weekends. Let's go back on over to the platform here. Let's finish up on a strong note. Let's go ahead and get into some supporting evidence, bond relationships. This is telling us the market's kind of fearful of that longer end rate, right? So interesting as the 30-year rate breaks out. I know we were looking at the 10-year just a second ago. If I pull this chart back up, the 10-year is down here at a 4.745. Oh my God. Then you go TYX, CGI, so we have to type in after it. This is the 30-year rate. I mean, what on earth, right? Go to a weekly chart on that. You're breaking out of a super long base on 30-year interest rates, right? So does this have the ability to go higher, like much higher? What's a monthly chart look like? You know, could we start looking at rates 6.4 on a 30-year basis? It's going to be pretty tough to want to put money in a market that's seemingly overvalued if you can get a guaranteed 30-year 6%, right? Or 6.4% for people with like large sums and want to de-risk and say, okay, risk-free rate, sure, right? 30 years, yeah, sign me up for a little bit of that. So that's cool. And a little bit more of a alarming signal, if you ask me. But let's go back on over here. Let's get into credit spreads. Credit spreads still higher, kind of neutralizing, but they're higher in these little short-term uptrends. That's bearish, or at least risk off. Let's go into the HYG, junk bonds here. Still sitting on a lower high versus this. No, HYG is higher. We're in confluence, HYG. So that's fine. HYG is not telling us to be overly skeptical here. Let's go to total breadth. Let's go full screen on each of these panes for a second. Nice coming in, nice coming in. I mean, breadth hasn't really expanded here. Right. One of the things that I would like to see if the market is going to go make new all-time highs is a new high in the new high, new low ratio, right? If that can happen, then maybe we've got more participation out there. But for now, this is not really what you'd like to see to call like a firm bottom shaping up, I don't think. It's not even oversold for what it's worth. If we're looking for an oversold capitulation, show me some deeper reads down here on the lows before we really start having that conversation. It's just not even close, right? So we haven't really capitulated. This Leo guy has been capitulated, but that was about it. If you look at the RSP, equal weight, nice long-legged hammers over here. Is that just a daily high or low? Certainly could be. Breakout there is probably going to keep the S&P churning. And this is the thing to remember, right? The RSP is gonna mask the fact that your high beta growth is still getting its butt kicked, and the S&P might go sideways or just down less, but you're probably still going to run into problems trying to get the market substantially higher, because we do need those growth names to actively fuel literal growth in the market, right? So that's a comment and a concern from the RSP. Equal weight NASDAQ, not a shock to see this over here, weaker than the RSP. Let's finish up on volatility, buzz the core list of companies, and then I've got a whole slew of ideas to just sort of walk through. Charts I'm interested in, really. Not all of them are actionable. This is interesting. Volatility is collapsing underneath the trendline break. That's a little bit more compelling. But if you go take a look at something like the VIX, I think it's EQ, right? VIX EQ, which is the constituent weight volatility, it's still in an uptrend, right? And let's just go to a weekly chart here. It's not like we're anywhere near like a settled low. I don't know if this has enough data, actually. Yeah, this is all we get. It doesn't have enough data in the constituent part, but your VIX constituent, which is the individual components of the S&P 500, what does their volatility look like relative to the index level volatility, right? It's still elevated, and you could certainly set a higher low here. And it's the popular term to start using is the dispersion, right? So really dispersed market, and individual components are moving way more than the index itself. Sure, all of that stuff. What this is telling me is, even though you're looking at the VIX in isolation here and saying, wow, the VIX got crushed last week, that's got to be bullish. Not really, when the VIX EQ is still in an uptrend. I mean, yeah, it also came in a little bit, but generally volatility is still above. Look at that, right? Are we just going to bounce off of that? Is vol going to pick right back up? I wouldn't be shocked. It's too bad that this instrument doesn't have enough price history to go back to 2022. Be a really interesting comparison. All right, next up we have from the VIX, the VVIX, volatility of volatility also coming in. So, bulls would want to latch on to the volatility compression over here a little bit. Strong contango still across the board here. We didn't reach into a backwardation, and the one-day VIX also lower to end the week. That is it. So bulls have volatility compressing at the index level. Bears have it expanding still at the constituent level. I'm probably Shout out to everybody who's going to correct me in the comments on that one. NVIDIA, what do we have going on over here? I don't mind the base. I really don't mind the base at all. Is this some sort of a double bottom off the daily 200 SMA? Is this going to keep the S&P anchored? Could. I really like this 200 SMA. Well, yeah, 200 SMA hold down here, but $200 level. Brigade bolts up and over that. Pretty constructive for the top side. Let's see if we can get a rally back up to the highs, and this turns into a left double head, right shoulder, and then we're here. Wow, impressive for the S&P. So it needs some time, but we're working on it. Let's go to an hourly chart. Yeah, your rounded bottom, inverted head and shoulders. Ideally, you're just holding over 198.15. That was the breakout level. 198.15 is the spot to watch. Let's go on over to this Apple, which got crushed on earnings, of course. Big gap down into about $300. This is actually a really nice spot for it to find support. If we can go inside day and then a break, excuse me, up and over the 50 SMA reclaim, it's going to look maybe not exactly, but very similar to Google, right? So let me just go to Google quickly, then we'll bounce back to Microsoft. But there's your day of earnings. There's your inside day, break it, and a key moving average, and you're higher, right? So Apple, very interested in this. If we can go inside day and then boom, up and in, something that looks like that. So for higher on Apple. Consolidation, Wix, and something that does that, still in play. Still absolutely in play as long as this level holds from back off to the left. Let's go on over to Microsoft. Really impressive action on Microsoft after earnings here. Earnings gap and go, follow through the next day after being extended. Whew, wow, impressive. So as it stands right now, this to me is one of the arguments that says markets can go higher if this Microsoft base is going to resolve. Look at your weekly chart on Microsoft. Another one where you're like, okay, here we go. Oops, are we going back to all-time highs on Microsoft? I mean, this is a huge move over the last 19% off the lows there. So very impressive. And the trade ideas as we walk forward simply revolve around, do we set up a flag? Can we flag? Can we not do the same thing we did here, please? One of the worst failed breakouts in all of history. If we could just set up a flag, if we could do something here and remain constructive for topside, that looks really good. I will just remind you that we still have an unfilled earnings gap from 2 cycles ago, back over here at 478, and then this big shelf of flat top resistance at 492 is your next level above. So the idea on Microsoft, checkbacks for higher lows, Brigade bolts to close the gap. Maybe we then need a little bit more sideways, a month or whatever, and then we have this nice range to work from. That's that. Let's go on over to Amazon. Rinse and repeat of everything I just said over on Microsoft. Can we do this? And then can we go up and out into blue sky territories? If we do start working ourselves into the gap, ideally it's no deeper than this. So partial gap fill around 249. That level is probably really faint on the screen, but 249 is this neckline of what was attempting to be an inverted head and shoulders. Big failure here, but since then, really starting to shape up quite well. Let's go on over to Google. Probably not a new money long, probably looking for a look above and fail on Monday morning at 358 for shorts to pull back and then allow something to happen in here. We'll see if that wants to cooperate on the hourly chart. You can see how we're just kind of extended and straight into it. No hourly pullbacks on the intraday chart there. So look above and fail the 50. Can we pull back? First target the 20. If this does this and then that, we're higher. If it comes all the way in, I'd be looking for gap fill reversals and longs off of a higher low here from a daily perspective against that gap. Let's go on over to Broadcom. Let's go back to daily chart here. Not much to really say. Range bound. It's still just very disappointed in, let's just do this all the way to the front. There we go. A whopping 7 contracts on Friday. Fantastic for single stock futures of Broadcom. So not much to comment on over here. It's in the middle of the range. We'll do something and we'll do something maybe if there's enough volume on those single stock futures by that time. Metaverse, really impressive rally here off the lows from the gap down. A lot of things getting bid back up, especially in the hyperscaler mega cap Mag 7 space. So I like what I'm seeing. The reclaim of 540.25 is the critical thing. So if we could stay above that and close the gap, that's the higher low we need to hold. 540.25, this previous left side low, and then we close this gap overhead from earnings, or at least what remains of the earnings gap. If we fade off of that and fall under 540.25, good night. Nice knowing you. Zuckerberg's got more explaining to do and just can't figure it out. Let's go on over to this MU. Micron, which is basically looks identical to DRAM and SMH, still in a downtrend. Pretty gnarly failure at 900 on the Friday session, and honestly closing underneath this 850 is fairly concerning as well. Let's go to the hourly. Just when you think and just when everybody's like, oh, inverted head and shoulders, it's got to be higher. How about short-term, like mosquito pattern, right? How about no? How about no? Under 850s with acceptance, I don't know how you don't just set up an H pattern here and head lower, right? And sure, all those levered positions from Leo get absorbed. They get kicked right back to the market, right? This is not Uncle Bob down the street selling his 2 shares of MU on Friday. That's, we bought the book on Wednesday after hours or Thursday bright and early in the morning. And then fine, it bounced for a day. We unloaded the living heck out of it on Friday morning, right? That's kind of what this looks like to me. So I don't know. Don't want to be too much of a tinfoil hatter, but how do you say it's anything other than a downtrend? How do you say that this is anything other than a lower high? I just don't really see the constructive look yet. If it was going to be a savior, it needed to be it right here at 900, at the right shoulder, and just didn't happen. So MU needs more work, probably more of a bear myself on it in the short term until we find a better pattern and structure to work from. It's going over to Tesla. Tesla looks like it's trying to firm up a low down here, which is great because I'm short the 260 puts on Tesla, half the position still. So covered half for a nice 50% gain, or it's not a 50% gain, 50% premium received, and then still holding half. We'll see if we can't get some more action here towards these highs or something like that. Looks like a nice rounded bottom starting to shape up on Tesla from an oversold bounce perspective. Yeah, V is always much better, but for now, not going lower is good. And looking for this little base. If we go here to an hourly, looking for this little base to allow a little bit more reprieve in the upward direction. So some counter trend thoughts on Tesla longs are the idea. Let's go to JP Morgan, which is still in a nice uptrend over here. Post earnings looks good. Daily higher low holding the left side peak. Looking for higher on JPM. It's going over to AMD. Another one, my goodness, do I feel like a dummy not holding the short all day. I actually was lucky enough. I shouldn't say lucky because it was part of the game plan, but I was able to find myself in short AMD in the morning, and it just closed so weak on the lows. Zero DTEs you can't hold them. But anyways, beautiful move and just a rejection of overhead supply. So just even based on my own feedback in trading, I've been finding success in short-term lower high action versus trying to buy breakouts. And not that we've been tracking breakouts. We haven't even been buying them. I haven't been buying them. One of the ones that we tracked very closely was that Datadog, just to veer a little bit. On Friday, a very well-defined breakout level here, it went and immediately curled. Look at the 5-minute chart. I mean, you tell me, does that look successful or like a failure? That looks like a failure if I've ever seen one. So no good on that. And market feedback, just to reiterate it one more time, been rewarded much more shorting or at least not doing anything aggressive on the long side versus otherwise. So AMD 507, as long as we're below that overhead supply, checkbacks, lower highs, and continuing to drift lower. We'll see. Earnings this week, of course, will make it more difficult to trade options on. Intel, earnings in the rearview mirror, just looks like a lower high to me underneath the entirety of the overhead supply, right? How is it not that? It's just an H pattern into the lows. So I'm a little bit more bearish based on those charts. And once again, as mentioned in the intro, I look at the volatility and I look at the leadership breakdown, look at Intel, look at AMD, look at MU, and I just think to myself, like, how could we be staging the groundwork for a huge new rally in the index? Maybe it comes from somewhere just completely out of left field, but I just don't see it as of right now. The Mag 7s and the hyperscalers, we gave them their credit in the intro, right? They look like they're holding up well enough to anchor the market, but that's about it. So let's get into these additional ideas. We'll just kind of buzz through the list that I've put together. Let's go with NOW. ServiceNow is interesting to me over 113. Probably something that if I do go with it, it's probably a very small size position, or I'm looking to buy it on weakness into the moving averages and try to get a position here, front run the break towards the 200. Still under declining 200 SMA, so keep that in mind. I have a love-hate relationship with this ServiceNow. I think it looks like garbage here. I think it looks better over here. This is certainly hard to ignore. It's constructive, but the broad market context isn't great. So either an observer of the breakout and we'll start stacking evidence, undeniable evidence, if the market moves higher that breakouts are working, we get the green light, or we'll just say, wow, good thing like Datadog, we're an observer and it fails and it fizzles and it does nothing. So ServiceNow, CrowdStrike, undeniable relative strength over in this name, deserves to stay on the radar over these hammers, looking pretty good. So checking in on that one. ANET earnings this week. However, have to give it credit on that gap up from Friday. The main thing that I caught, or at least was catching my eye, was the reclaim of this 178.50 spot back above the breakout level. So we shall see. Gap and hold from Friday. It needs to offer a new setup, but certainly should be on the watch list for folks. SNOW. Snowflake, one of the breakouts that is starting to work. So we've got Datadog, no. Snowflake, yes. That's leaving us straight down the middle. in terms of our breakouts working or not. So keeping this one on radar for higher low checkbacks over 278.45. Let's go to path, UI path over here. This looks great out of this little base. Is this going to go on to be a leader? I don't know, but it certainly is starting to do the right things. It's a long-standing multi-month base. Can it start to go up and over this not VWAP, but the 200 SMA? Can we really start to get cooking? Look at the volume increase here, some accumulation through this consolidation. The shakeout is on kind of elevated volume, not going to lie, but good relative strength this week. That's for darn sure as it moves higher. So watching UI path here as it stays in the range. Let's go HPE, another one that I think a lot of people are all over this HPE. This looks pretty good, up and through that 50 level, holding the moving average stack. It looks very good, very, very good. So it's just a matter of does this breakout work? Because this one's so clean, I'd probably be willing to take this HPE versus ServiceNow, right? And also, what's the main difference? Over a rising 200, big leadership in the past, nice linear move. I mean, this, although maybe that means it's more crowded, I'm more trusting, of HPE versus ServiceNow. Let's keep going. We're going to skip that one. Let's go this one, ZS. Zscaler, one of the laggards of the cybersecurity stuff, but undeniably a nice little pattern down here is this sort of little micro cup and handle with a wedge up and over into the 200 SMA. Not bad. Just mind the weekly downtrend. This thing's pretty aggressive here on the failure. So just understand that it's not higher time frame charts are not pretty on that ZS. Let's go from ZS over to AFRM. And, as long as this can hold up in this range and not take out 69.75, a move back above the 50, is this just a higher low pullback in the context of an uptrend? Maybe AFRM. Let's go on over to AVTR, which is not Avator, but Avantor. Can this thing go look below and fail, right? Are we going to get some kind of move to stay in the range here and then break up and out? Maybe. So I'm watching the high of the Friday bar, honestly, on this AVTR, something over roughly like 1390s. Does this get up and out after the earnings gap and go? We'll see. AVTR. Next up, Ring, another, not Ring Doorbell, but Ring Central. A really nice weekly, monthly base. Look at this thing. Long-standing base, starting to break out. Let's go to the daily. Nice little break. Flagging now at these highs. Some relative strength to the broad market for sure. Definitely a successful breakout if we try to gauge it against what the broad market has done over 44.73. So that catches my attention. Another one, GTLB, GitLab. Really nice cup with handle happening over here. Nice flat top. 34.90s right over that level gets interesting. You're over the 200 SMA. You're over the moving average stack. It's pretty good on GitLab. That's definitely high up on the list. GM, General Motors. This one looks pretty darn good here for a flag over the multi-week highs, multi-month highs. Right, so 85.10s, a little bit of a lighter ATR on this one, but GM bull flagging here over the hammer candle looks pretty darn good. And then last one we'll give you is GRMN. Oops, Garmin. Shout out to Steven on this one. But we've got ourselves a really nice strong move on earnings out of this little base down here, and certainly well above that. Inside days, I don't know that we're just buying it through 298, but nonetheless worth watching for some relative strength. Post earnings, put it on a list somewhere. That's what I've got for you in today's episode and installation of the weekly watch list. If you enjoyed the video or learned anything new, feel free to let me know down below in the comments section, or by leaving the video a very simple thumbs up. No, we do not want to buy a custom on S&P. There we go. So appreciate you coming out to the show. As always, have yourself a fantastic rest of the weekend. We've got a loaded week as it relates to earnings. We are through the FOMC and most of Mag 7, of course. NVIDIA tends to be the laggard, but that is that. Have an awesome weekend. Stay green out there this week. And as always, I will see you in the next one.